There's a danger hiding in the market right now, and it's the kind that doesn't announce itself with alarm bells or flashing red lights. It's quiet. We call it the silent crash.
I mean, if you just look at the surface, everything seems fine, right? The S&P 500 over the last decade has been a beautiful, steady climb. It feels safe, it feels predictable. But that feeling of calm, well, that's the illusion.
Because history is sending us a very clear warning. Just beneath this placid surface, some pretty serious risks are building up, and the market, for the most part, seems to be completely ignoring them. And that is a dangerous, dangerous combination.
So, let's talk about the first risk. And this one, well, it's a pattern that's as old as the hills, a ghost from the past that has decided to show up again. We're talking about an oil shock. Now, look closely at this timeline, because the pattern here is, frankly, it's undeniable. Every time you see one of those big spikes in oil prices, we're talking a jump of 30% or more, what happens next? Take a look at those gray bars. Almost every single time, a recession is right around the corner. The connection is just crystal clear. And if you want the most extreme example of this, you just have to look back to 1973. The OPEC oil embargo sent prices skyrocketing by a staggering 400%.
And the fallout from that shock? Absolutely devastating. The S&P 500 lost nearly half its value. It plunged 48%.
Okay, so here's the kicker. This exact pattern is happening again, right now. Because of major disruptions in the Strait of Hormuz, prices have already spiked 50%. In fact, some analysts are calling this the single largest supply disruption in history, potentially 3 times the scale of that 1973 embargo that just crushed the market. But here's the thing about an oil shock. It isn't just about the price you pay at the pump. No, it creates a much deeper, much more dangerous economic problem. It's a trap with no easy escape.
And that trap has a name: stagflation. You've probably heard the term. It's this really toxic mix where the economy just grinds to a halt, but prices for everything, food, gas, rent, they just keep on rising.
And this right here, this shows you why it's such a trap. The central banks are completely paralyzed. If they cut interest rates to try and get the economy growing again, they risk setting off runaway inflation. But if they raise rates to fight that inflation, they could completely crush the economy. It's an impossible choice, and there is no easy answer.
And in a situation like this, you'd think pure logic would win the day, but that's not how it works. Politics takes the driver's seat. Right now, there is immense pressure on the Fed to cut rates, to get the economy going, no matter what that might do to inflation down the road.
We've seen this movie before, Back in the 1970s, the Fed caved to exactly this kind of political pressure. And the result? A totally lost decade for investors. We're talking runaway inflation and a stock market that, in real terms, went absolutely nowhere for years. Just how bad was it? Well, research from the asset manager Schroders shows that during those historical periods of stagflation, the average real return for stocks, that's after you account for inflation, was negative 1.5% per year. You were actually losing money. And that right there is the silent crash. See, it's not some sudden, dramatic 50% drop that grabs all the headlines. No, it's a slow, quiet death by 1,000 cuts. It's your wealth being eroded year after year as inflation just silently eats away any gains your portfolio seems to be making. It's so much more dangerous than a quick crash because most people don't even see it happening until it's far too late. Okay, on to our third risk, and this one is a bit different. It's a hidden vulnerability, and it's hiding in the one place most of us feel the safest, in diversification. So if you own an S&P 500 index fund, you probably think you're safely spread across 500 different companies. But look closer. Would you believe that over a full third of the entire index's value comes from just 7 tech giants? Your so-called diversified portfolio is really just a huge concentrated bet on a tiny handful of stocks.
And you want some perspective on this? Data from Morningstar shows that the market is now more concentrated than it was at the absolute peak of the dot-com bubble back in 1999, and we all remember how that story ended.
What this creates is a massive cluster risk that so many investors are just completely blind to. And it forces us to ask a really critical question. What happens to the entire market if those 7 pillars all start to wobble at the same time?
Okay, so let's just recap. We have the oil shock pattern repeating itself, we have the stagflation trap, and we have this massive concentration flaw. Now I know, the picture seems pretty bleak, but it's not hopeless. The question is, how do you navigate a potential storm like this one?
So, what does history tell us? Well, this analysis from Schroders basically gives us a data-driven playbook. In past periods of stagflation, while stocks were actually losing value, other assets did incredibly well. Gold delivered an amazing 22% real return per year. Commodities and real estate, through things like REIT, which are real estate investment trusts, they also offered really strong protection and even helped grow wealth.
And what if you want to stay in stocks? Well, the playbook suggests you might need a strategic shift. Maybe you look for value away from those huge, concentrated U.S. tech giants. Think smaller companies or European markets. Or you could focus on sectors that are resilient no matter what. Things like utilities and consumer staples. Some analysts even see opportunities in good software companies that might have been unfairly beaten down.
So when you boil it all down, here's the crucial point. In an environment like this, the single greatest risk you face isn't the price of oil or what the Fed does. It's complacency. It's just assuming that the calm of the last 10 years is going to continue forever. And that means the greatest opportunity right now is preparation.
So there you have it. You've seen the patterns. They've been hiding in plain sight this whole time. The real question isn't if you should prepare, it's how you will. What's your next move?